Okay, let's dive right in. We're going to look at one single, really fascinating day in the markets, October 22nd. Now, on the surface, it might seem like just another Tuesday, but it's actually the perfect snapshot of a market that's stuck at a major crossroads. We've got a powerful rally that's suddenly hitting a wall, central banks are starting to go their separate ways, and there's this wild mix of incredible ambition and, well, some deep-seated fear. So let's try and untangle these conflicting signals and figure out what's really going on.
First up, the big picture. For weeks, the market was just on an absolute tear. A lot of people were calling it the everything rally because, it felt like no matter what we bought, stocks, gold, you name it, it just kept going up. But on this particular day, all that momentum, it just stalled, and we started to see the first real cracks appear in the foundation.
And this quote just nails the vibe shift perfectly. That feeling of unstoppable momentum, it suddenly slammed into a wall of doubt. It's that moment when the music at the party kind of fades and everyone starts looking around, wondering if the whole thing was built on solid ground to begin with.
And here is Exhibit A. I mean, look at this. This wasn't just a little dip in the price of gold. This was the sharpest single-day drop in more than 10 years. When you see a move this violent, especially after a huge run-up, it's a classic sign that people are cashing in their chips on a massive scale. It tells us investors are getting nervous and their appetite for risk is fading fast. This nervousness wasn't just a gold story either. Over in the stock market, that powerful US rally suddenly hit the brakes. The S&P 500 just went flat. It's a clear signal of what we call buyer exhaustion. Basically, the buyers ran out of steam. There just weren't enough people willing to pay higher prices. So, the big question is, what's behind this sudden, widespread case of cold feet?
Well, the huge piece of this puzzle is what's happening with the world's central banks. For a long time, they were all singing from the same hymn sheet, all fighting inflation together. But now, for the first time in a while, they're starting to go their own separate ways. And that divergence is creating a whole lot of uncertainty for the markets.
And this slide just lays out that divide perfectly. It's a tale of two worlds. On one side of the globe, you've got the UK, where a surprise inflation report has traders betting aggressively that the Bank of England is going to cut rates. On the other side, Indonesia's central bank is doing the exact opposite. They unexpectedly held rates to protect their currency. Two totally different economies, two totally different playbooks.
So let's zoom in on the UK for a second, because this data was a real shocker. Just about everyone thought inflation was going to tick up. Instead, it held steady, mostly because food prices came down. Now, this is a really big deal because it completely changes the math for the Bank of England. And the market's reaction? It was instant. The odds of a December rate cut just skyrocketed, and that sent the British pound and UK bond yields tumbling down. Meanwhile, back in the US, the markets are also betting heavily that the Fed is going to cut rates. But the key takeaway here is that this is not a globally synchronized thing anymore. While the big Western economies seem to be leaning towards easier money to juice up growth, other countries, like Indonesia, are fighting completely different battles, in their case trying to stop their currency from weakening.
And all this central bank divergence, well, it feeds right into our next big theme, a major strategic shift in where global money is flowing. And a big part of that story is geopolitics and the weakening US dollar.
This quote from KKR's co-CEO really puts it all in perspective. The idea isn't that investors are just ditching the US entirely, it's more about where that next dollar of investment is going. As the US dollar gets weaker and Asia's economy looks stronger, that part of the world just becomes a much more attractive place to put capital to work.
And right at the center of all this is the super complicated relationship between the US and China. We hear all this talk about decoupling, right? But the reality on the ground is, well, it's messy. Even with these massive tariffs in place, about $1 billion worth of Chinese goods still flows into the US every single day. It just goes to show you that even as the political ties get strained, the economic connections are incredibly deep and tough to unwind. And here's a perfect real-world example of that capital shift in action. A private equity giant like KKR isn't just talking about Asia, they're putting their money where their mouth is. Japan is now their biggest market in the entire region, 40% of their Asian assets. And get this, they're eyeing Japan's massive $14 trillion pool of household savings as a huge untapped resource. This isn't just one company's strategy, it's a huge signal of a much bigger trend.
Okay, so let's shift gears now. Let's come down from that 30,000-foot macro view and look at what's happening at the corporate level. Because here, we see this fascinating split personality, this tug of war between mind-boggling ambition on one side and some pretty deep-seated anxiety on the other. First, the ambition, and I mean ambition. SoftBank is reportedly planning to pour a staggering $500 billion into its Stargate AI project. Just let that number sink in.
$500 billion. It's almost hard to comprehend. This is the greed side of the market equation, just turned up to 11. But then, you have the fear. This quote from the CEO of Barclays just perfectly captures the anxiety that's bubbling up in the credit markets. He's talking about one specific bad loan, but the question he's asking is the one that's on everyone's mind. Is this just a one-off problem, or is it a symptom of a much bigger sickness spreading through the whole system?
And this slide connects those dots. That big loss at Barclays was tied to a US subprime auto lender that went bust. That's worrying on its own, but it's happening at the exact same time the head of the Bank of England is warning about alarm bells in the private credit market. You know the saying, right? If you see one cockroach in the kitchen, you start to worry there are a lot more hiding in the walls. That's the fear here.
So we've got this massive tug of war playing out. It's ambition versus fear. It's diverging central banks and shifting global capital. So how do we make sense of it all? Let's look at a few tools that try to cut through all that noise and actually measure what investors are feeling.
Okay, one of the most popular tools for this is the CNN Fear and Greed Index. It's a fantastic concept, really. It's designed to answer one simple question. Right now, are investors feeling greedy and piling into risky stuff, or are they feeling fearful and running for safety? It's not magic. It just does this by blending together a whole bunch of different market signals, things like momentum, volatility, stuff like that. Essentially, it just boils all that complex data down into a single simple score that gives us a snapshot, a kind of vibe check of the market's collective mood. It's a great way to take the market's emotional temperature.
And it's not just about the big institutions either. We can also get a little peek into what retail traders are thinking. Tools like this one can actually show us where clusters of buy and sell orders are sitting for major currency pairs, like the dollar-yen. It's another valuable layer of data on how different parts of the market are feeling and where they're placing their bets.
So, where do we go from here? With the market at this clear crossroads, all eyes are turning to the economic calendar. As we can see from the information from investing.com, the next huge data point is the US inflation report coming out on Friday. That number, plus a fresh batch of earnings reports from some of the big tech companies, will very likely set the tone for the market's next big move.
So that's the picture we get from this one single fascinating day. We have a powerful rally hitting a wall, we've got central banks no longer in sync, and a corporate world that's totally split between incredible ambition and crippling fear. And it all leaves us with one big overarching question: was this just a temporary blip? Just a moment for the market to catch its breath before the next leg up? Or are we witnessing the very beginning of a much more fundamental turning point for the global markets? Thanks for watching. If you found this breakdown helpful, be sure to like and subscribe for more.